Good morning and a very warm welcome on this cold winter's morning in Sandton. Thank you for joining us for the presentation of our 2023 mid-year results. I'm joined by Barbara Makbede, our CFO. If we lose power in the next half an hour, it's because the load shedding has stopped in Sandton and our generators kick in normally immediately, but just hold on, we will be back if you lose us for a few seconds. We will take you through our presentation and address any questions at the end. The first 6 months of 2023 presented a dynamic landscape for our industry as it faced the fair share of economic, power, and other challenges. Adapting to these sometimes volatile conditions, we had to employ agile strategies to meet shifting demands while ensuring operational resilience. With that as a backdrop, L2D's half-year financial performance showed good growth versus the comparative period across several key metrics. Our board have declared a mid-year distribution of 18.77 cents per share. This is a 7.4% increase compared to the half year 22 and at the top of our guidance range. Net property income reflecting an 8.2% increase on the same period last year. Costs have been well contained, with property operating costs reflecting a 5% increase, well below CPI. Our LTV ratio remains stable at just under 25%. You would have seen this announcement published on Sense last week, in which it was announced that the Liberty Group proposed to acquire all the shares of Liberty 2 Degrees held by minority shareholders at R5.55 per share, a 46% premium to the 30-day V-WAP prior to the announcement. Our independent board believe this is in the best interest of all our stakeholders. The operating climate, as I said, for the first half year has been filled with continued inflation pressure, increased interest rates, escalating municipal rates, and prevailing power shortages nationally. What has been very encouraging is the steady flow of customers to our malls, as customers still favor retailers and brands with a physical presence in the search for inspiration and a dynamic, interactive experience. This is aligned with several tenants that we've seen upgrade and refresh their stores in our portfolio for better sensory appeal, truly making brick-and-mortar retail essential in the omnichannel customer experience journey. If you follow the norm, there are these ground rules that everyone tells or expects you to follow. But sometimes it's when you break them early on that the real magic is created. True for life, but also true for experiences that delight in every way. This has enabled us to deliver sound operational and financial performance in the face of the prevailing macroeconomic challenges. I'll now go through the detailed performance against each of our strategic value drivers. Starting with customer experience. Step Hyken said that customer delight is not just meeting customers' expectations, it's about exceeding them in unexpected and memorable ways. Our teams focus on this with great attention and genuine care. L2D's portfolio turnover and foot count are now well ahead of pre-COVID levels, and we won't focus on the comparison of it in detail anymore. The portfolio generated a 6.8% increase in turnover compared to half year 22 and recorded a 9.1% growth in foot count compared to the same period. Customer experience is inherently tied to our purpose of continuing to create experiential spaces to benefit generations. We do this through extraordinary experiences, exciting them with unique offerings and delivering service across multiple touchpoints. Sandton City hosted the largest Lego Lugs event ever in Johannesburg, which was for adult fans of Lego, and received the opportunity to build and exhibit their Lego sets. It's been such fun to watch. We are also proud of the recognition received by Sandton City on a global scale for its festive season Toyland activation, which was nominated in the experiential category at the 2023 Maxi Awards run by the International Council of Shopping Centres. Our hospitality sector has shown strong performance, with the hotels achieving a combined occupancy of 61.3% for the first half of 2023 compared to 53.7% for the same period last year. The Sandton Sun has maintained its good occupancies while its RevPAR has improved further in comparison with half year 22 and now 42% above pre-pandemic levels. We have seen increased activity at the Sandton Convention Centre with 101 events over the first half of the year and provides further support to the hotel bookings. What has been particularly pleasing is the strong recovery in larger events, with the bookings for the remainder of the year more balanced. Return clients are positive about future events, with high attendance they have seen for the events to date. If we move on to tenant experience, without our tenants, we can't fulfill our customer promise. Occupancy across the portfolio remains stable in this operating environment. L2D maintained good occupancy levels at 93.6%, 93.5% at December 2022. The retail occupancy at 97.1% remains ahead of the MSCI Q1 benchmark of 94.6%. It is very marginally down from 97.9% due to Ster-Kinekor vacating at Promenade. Opportunities to re-let this space to create more of what the Promenade community wants are being progressed. While L2D's office portfolio represents only 26.2% of the total GLA, and therefore carries less weighting on the overall vacancy, we remain focused on office leasing, which has improved to 82.1% versus the 80% we had in June. Our two super regionals, Sandton City and Eastgate, have maintained high occupancies of 99.3%, Sandton is almost full, and 95% for Eastgate. The combined occupancy of 97.2% is well ahead of the MSCI super regional benchmark of 94.4%. Our management team remains focused on office and retail letting and will continue to drive leasing initiatives in line with our asset strategies. We don't just fill vacancies, we consider the right tenants for our long-term strategy. Our malls continue to attract various tenants with many new stores being introduced, such as Columbia, Puma, La Parada, Mario Casas, and Sealand, amongst many others. New to mall tenants, as we call them, as at the end of June, brought 3,700 square meters of exciting new offerings. Of these, 34% make up new food offerings, and new apparel tenants making up 31%. While we enhance the tenant mix by introducing new tenancies, current tenants also continue to invest in their stores within our portfolio. 31 tenants, representing just over 5% of our GLA, have upgraded and refreshed their looks and the feels in their stores, reaffirming their commitment to our portfolio and enhancing customer experience by bringing their best and world-class offerings to our retail environments. Some of these tenants include Zara, Nike, Cartier, Burberry, and the iStore. The flagship Zara opened in Sandton City in May 2023 with 25 trading days for the month, generating 50% higher turnover than May 22. The new Nike store at Sandton generated around 4 times the turnover it did in its old store during the 2 weeks after opening. The upgraded iconic Apple flagship in Sandton opened on Saturday, and it makes you feel genuinely like you are standing in New York or London. Other luxury brands that are upgrading their stores include Burberry, Dolce & Gabbana, and we are looking forward to their imminent reopenings. Versace has relocated to create a new store, and Balmain will open at the end of September. As of June, we concluded 125 renewals on a like-for-like space basis, amounting to 42,000 square meters. The priority has been to turn around the high negative reversion rate, particularly in the retail portfolio. If we remove the Melrose Arch reversions, our retail reversions are now positive at 1.1%, with the overall reversion rate at negative 0.3% if you include Melrose Arch, compared to just under 10% negative at the end of 2022. This significant improvement is based on the conclusion of 101 leases of 40 to 24,000 square meters. The negative impact on reversions is largely due to non-turnover generating categories, which mostly consist of our banks. As we move to a more digital banking world, the banks are looking to reduce their cost of occupation. However, we believe there is a strong need for physical, high-touch bank service centers within our portfolio, and we continue to engage with them on how they can be positioned to leverage the physical and digital intersect. The retention rate for the renewals concluded to June was 86.3%, largely due to Ster-Kinekor and the Promenade vacating, as I mentioned earlier, alongside other minor tenancies across the portfolio. If we look a little bit deeper into the renewals, 21.2% of the portfolio GLA either expired or was up for renewal within the 2023 financial year. Of the total renewals, the team renewed 23.5% in the same premises or space like for like, 17.6% renewed by way of relocation of a store or store reconfiguration, and 6.5% was given notice to vacate due to poor performance. The remaining 52% are largely made up of department stores and apparel retailers, where discussions with the tenants have already progressed well to renew. We remain confident of a continued favorable leasing outcome as we enter the second half of this year, supported by the improved trading that I will share with you now. In the graph, you see the annual trading density percentage growth for the portfolio compared to the Belinda Kleur International Centers benchmark. It's the Belinda Kleur International benchmark for all centers, just it's not an international benchmark. L2D continues to outperform the all centers benchmark, with the portfolio average annual trading density ahead of May last year by 13%, versus the benchmark at 10.1%. So they're both tracking ahead of CPI. You'll remember that I said super regionals and regionals are very much alive. Our portfolio annualized trading density is 30% higher than the benchmark at the end of March. If we take a deeper look at the segmental performance of the super regionals and regional centers, both achieved an annual trading density growth rate of 18.8% and 9.2% respectively, well ahead of their benchmarks. In addition to these growth rates, the larger centers have also been able to maintain high trading densities, which is a key strength of the diversified tenant mix. Sandton City, our real diamond, outperformed the super regional index considerably over the period, closing with 19.6% annual trading density growth, beating the index by 5.5% as well as CPI over the period, and just demonstrate the quality of this asset. The center consistently outperforms and now has a annual trading density of 78,800 per square meter. That is 69% above the Q1 super regional index. This showcases the extraordinary position that the center holds within South Africa's retail landscape. While Eastgate's annual trading density remains marginally below that of the benchmark, it continues to show resilience and has moved to stronger territory in H1 under its new positioning strategy. Dining has been reintroduced to the lower level, which is reinvigorating that area of the mall. Checkers is also undergoing a major refurbishment, which will offer customers an enhanced shopping experience. A similar trend can be noted on the performance of our regional centers, with both Midlands and Promenade outperforming the Clear regional benchmark. Promenade's average annual trading density is ahead of May by 9.3%. Midlands, however, is down by 3.7%, largely driven by the reopening of neighbouring centres impacted by the July 2021 riots. Midlands continues to trade ahead of pre-COVID levels. If we look at the overall turnover for the 6 months, it is up 6.8% as compared to the first 6 months of last year. The large contributors to this increase in turnover are Nelson Mandela Square and Sandton City, who grew by 16.9% and 10.2%. Growth has remained resilient despite various store closures who didn't contribute to turnover during their refurbishments, such as Zara, Cartier, iStore. And if we get those back, we're looking for further turnover growth. Nelson Mandela Square is a retail-focused centre contributing 51.6% towards its total turnover. The offerings at this dining destination of choice are being enhanced with a butcher shop having reopened post its upgrade, while a new La Parada is set to open at the end of August. From a category perspective, the food services, department store, and apparel categories showed the largest increase in rand value versus H1 22. It is encouraging to see department stores, which have lagged the portfolio, as well as food services, which was hardest hit by lockdown restrictions, continue to improve. It's not us taking off, it's just our air conditioner going on here. We continue to look out for customer spending behavior and lead indicators to understand the potential risks to the trading environment. The categories displayed on the category performance slide represent the top 10 categories, ranked according to their contribution to the annual portfolio turnover. Together, they contribute about 94% of the total turnover. The apparel category continues to lead in total portfolio turnover contribution, followed by department stores and food service. The food service category has displayed the highest growth since prior year. This is supported by consumer preferences to dine during intensified periods of load shedding. The category that has displayed the second highest growth compared to prior year is once again luxury brands, despite major luxury store brands temporarily closing for a few months to enable their refurbishments, such as Cartier, Burberry, D&G, as we've spoken about. Furthermore, all categories noted above have surpassed the Q4 22 annualized trading density benchmark apart from the specialty category. And that's really a good indicator for future rental performance. It really confirms the quality of the assets we have and the trading environment created by our team of exceptional, passionate property people. I will now hand over to Barbara to take us through the detailed financial performance of the portfolio.
Thank you, Amelia. Good morning, everyone, and welcome to our 2023 interim results presentation. As Amelia indicated at the start, the net property income, excluding lease straight-lining, increased by 8.2% to 295 million. This is versus the comparative period. This was supported by the core retail portfolio, a strong recovery in our hospitality assets, and higher expected recovery rates at Sandton City, Nelson Mandela Square, and Eastgate. Cost containment has been managed well, with property operating expenses reflecting a 5% increase and head office operating costs increasing by only 2% compared to the previous year. The ongoing electricity crisis and load shedding has resulted in increased diesel cost, but this was partially alleviated by the improved diesel recoveries since the beginning of this year. The net interest expense increased by 18.7%. This was due to the higher interest rates post the refinancing of the debt with higher hedge ratios. The increase in profit before tax included the positive fair value adjustments of some 34 million. This was in respect of the property valuations that we concluded at the end of June 2023. All of the above has resulted in distributable income growth of 7.4%. Looking at our NPI growth and contribution per sector, the retail sector remains the core to the portfolio, contributing 79% of the portfolio's NPI and posting a growth of 3.3%. There are a few key themes that underpins this outcome: increased turnover rentals, higher expected recovery rates on municipal rates, and increased sundry income and parking income, as well as focusing on managing cost well. We have also seen the average net rentals for all retail segments that have increased versus the comparative period. Our hospitality sector has continued to show encouraging improvement in performance, with increased occupancies at the Garden Court, the Sandton Sun, and the Sandton Towers, as well as increased events at the Convention Center. The NPI from the hospitality assets was 16.2 million for the half year. This is a significant growth compared to the comparable period. The NPI in the office assets increased due to an adjustment on the municipal rates in the Sandton complex following the VAB outcome, where the retail sector had a higher allocation than the offices. And this number also includes the historical adjustments and therefore a once-off in nature. The net property income growth from the offices remains challenging in the oversupplied market. While the office assets remains under pressure, the improved occupancies, particularly in Sandton, are very encouraging. Coming to the statement of the financial performance, we continue to maintain a very strong balance sheet and align our capital allocation with our core strategy with a focus on sustainability projects in order to improve efficiencies across our portfolio. The loan-to-value ratio is 24.58% for the end of June this year. This is with a healthy interest cover ratio at 2.89 times, and both are comfortably within the banking covenants requirements. The interest rate exposure is 80% hedged. And as at 30 June 2023, the average cost of debt was 9.2%, with total unutilized credit facilities of some 308 million. We are engaged in discussions around the refinancing of the $500 million of debt that is maturing during the second half of the year. L2D's property portfolio was valued at 8.3 billion as at the end of June. This was a 1.2% increase on the June 2022 valuation and some 0.9% increase on the December 2022 valuation. These values are based on an independent property valuation, which is in line with our L2D policy to have external independent valuations on the entire portfolio performed at both interim and financial reporting dates. Diesel consumption in the first half of the year was significantly higher than the prior year, resulting in higher diesel costs. The total cost for diesel amounted to 13.4 million at L2D ownership level for the first half of this year. This is a significant increase compared to the 2.3 million which was incurred in the first half of 2022. That was before the load shedding ramped up significantly in the second half of that year. For the full year of 2022, 11.5 million was incurred. The diesel recoveries have been successfully implemented since the beginning of this year, with the diesel recovery for the first half of this year totaling some 8.7 million, and this resulted in a 65% recovery rate on diesel. Looking at the composition of the property operating expenses, most of the cost comprises of rates and utility costs. We also see a significant increase in the contribution of diesel to this cost base. While these are externally driven factors, we continue to focus on cost across the portfolio as well as the strategic deployment of capital on sustainability projects. The debt metrics remain within our covenant levels, and this has been a key enabler in navigating this tough operating environment. We have remained prudent in managing our capital to protect value during these uncertain economic times and create a platform to deliver sustainable operations going forward. This is evident in the financial results that we are delivering today, and we look to build upon this going forward. I now hand back to Amelia. Thank you.
Thank you, Barbara, and well done to you and your team for bringing these results out so quickly after year end. Let's look at our ESG progress. Our Good Spaces strategy supports our business by prioritizing the key environmental sustainability issues facing our business by considering short, medium, and long-term horizons and helping L2D adopt environmental best practices whilst we are driving our bold targets. Our current initiatives that focus on creating value while reducing our impact on the environment include the following. The solar installation at Midlands, comprising 4 MW, was commissioned at the end of July. The system is expected to further reduce our reliance on the grid by 25%. At Eastgate, 1 MW of the plan 4 is in progress and will go live by the end of December. We are also evaluating wheeling for Sandton and further battery solutions at Eastgate. Our net zero waste milestones are nearing completion, and we are gathering the data set for the 12-month period for submission to the GBCSA. This allows us to receive our net zero waste certification before the end of the year, thus achieving our net zero waste target. I'm really proud of our team for really pushing this hard. Earlier this year, we reported on replacing water-cooled air conditioning systems with air-cooled systems, and this will be underway in Midlands during August and will aid in reducing both water and energy consumption. We have made good progress in exploring black water harvesting systems per asset as part of our net zero waste journey in 2025. We have also progressed our biodiversity strategy. L2D registered for science-based targets and look forward to sharing further on our progress. If we look at our people and our communities, we continue to strive to connect stakeholder needs to social impacts. And for the period, we focused on giving back to our communities as well as embedding diversity, equality, and inclusion within our teams and upgraded skills development in the industry. The composition of all the people in our business are fully diverse, from our board to our executive team and the rest of our business, not only in terms of gender and race, but in everything that we do. A position that we intentionally implemented and we are proud of. Skills development is critical for long-term positive impact on the property sector and our communities. To date, our bursary program has supported 31 students. We remain committed to positively impacting the communities in which we operate. Our community engagement strategy ensures that our social investment impact is meaningful. L2D, along with the Department of Justice and Constitutional Development, the Gauteng Department of Education, and the French Embassy, hosted learners from 2 schools in Alexandra at Mandela Square to showcase what it means to live the Constitution through art as part of our partnership with the Valued Citizens Initiative. This Sondela Open Dialogues initiative provided a platform to amplify the voice of the youth on current matters and social ills through open dialogues that took place earlier this year. As a business that is committed to genuine socioeconomic participation and true transformation, this initiative resonates soundly with our internal values around diversity and inclusion, and our promise to create safe spaces that allow for participation, expression, and inclusion for all South Africans. I am proud of all the initiatives our teams are involved in. It is an indication of where the hearts of our people lie. You would have seen the joint firm intention announcement made on 27 July, last week Thursday, in which our independent board, chaired by Peter Nelson, is recommending the offer from Liberty to buy out our minorities and delist L2D. The full terms of the proposed transaction will be contained in a scheme circular expected to be issued towards the end of August. However, I thought it would be useful to highlight the salient points of the transaction. The proposed offer is for a cash consideration of R5.55 per share, representing a premium of 46.4% to the 30-day V-WAP on the day prior to announcement. In addition to the cash consideration, L2D will, under the guidance of its independent board and to the extent applicable, declare a clean-out distribution to shareholders accruing in respect of the period from 1 July. This is in addition to the interim ordinary distribution declared today. We believe that, and also our independent board believes strongly, that the options to unlock the full potential of the L2D property portfolio would be enhanced through a consolidation of L2D with LGL and the management of the consolidated portfolio outside of the listed environment. The proposed transaction would also afford minority shareholders the opportunity to exit their investment in L2D at a significant premium to the market price, which would otherwise be a challenge in the current market. After careful consideration of the terms and conditions of the transaction, and after considering the independent experts' pre-final report, the independent board has concluded that the terms of the scheme are fair and reasonable to L2D shareholders, and as a result recommend that shareholders vote in favour of the scheme resolution. This consolidation is an important step in L2D's value creation journey. The past 6 months of the year has been somewhat in perfect balance. For every tough moment, and there were many, there have been equal moments of interesting opportunities and catalysts for change. Consumers' disposable income continued to be faced with a number of headwinds, while ongoing load shedding, as we just had, dampens the economic growth. Yet, our trading performance has been extraordinary. Rental negotiations have been tough, yet our reversions have turned positive. A very deliberate focus on cost remains at the forefront of what we do, yet our investment into our sustainability initiatives to manage these costs have yielded good value creation. Our journey in the listed sector has been full of interesting challenges. We are now able to provide shareholders with, on recommendation from our independent board, with a great premium in this current market during the transaction proposed. So, in the end, it is all good. This brings us to the end of the presentation. I would like to express my sincere gratitude to all of you for supporting L2D during these last 6.5 years. Your challenges to us, your difficult questions, made us expand our thinking to do what is best for our business, combined with the equal measures of genuine support and good relationships, made for a real privilege to lead this business. Thank you. We will now take your questions.
Thank you, Amelia. The first question comes from Peter Kromberg from Merger Market, and it's directed to you, Barbara, regarding the refinancing. Can you please provide some more detail on the refinancing of the 500 million rand of debt that will be maturing in October?
Thank you. Yes, we do have the 500 million rand that is maturing at the end of October, and we have been engaging with the banks. We have received very positive feedback so far, and we will finalize the discussions during this next coming weeks.
Thank you, Barbara. The next question comes from Francois Dutoy from Anchor Stockbrokers. Francois is referring to the average net rental that is disclosed per property in the supplementary section of the presentation. He notes that the average net rental at Sandton City increased strongly, but it decreased at Nelson Mandela and Melrose Arch. And what do we ascribe Sandton City's superior retail rental performance to?
Thank you, Francois. I think the answer to the question in what drives Sandton's rental performance is contained in what I have explained around the trading density. At 78.8 thousand rand a square meter trading density, you can imagine that rental uplift from that is quite significant. At Nelson Mandela Square, it comes off a base that had a lot of closures and temporary closure as a result of the lockdown, and it needs some time to still pick up. Eastgate's, you didn't ask about Eastgate. Melrose Arch is a challenging environment, one that we don't manage ourselves but have an investment in. And we continue to assist them in looking for new tenants, but that environment remains challenging. And you would recall that I had said that it impacted our positive reversion rate specifically through what's going on at Mauritshuis.
Thank you, Amelia. At this point, there's no further questions. Just a reminder to anyone, if you do want to send through a question, you can type it into the box.
No further?
There's nothing further.
Thank you. If there are no further questions, you are very welcome to send a question to Sementri at investors@liberty2degrees.co.za. Other than that, we'll be seeing most of you during our one-on-one meetings later in the week. Thank you again for joining us this morning, and have a lovely day further.